Good morning. Happy Tuesday. Happy April 9th. No, yes, it's the 9th. So I realize I forget to introduce myself half the time. I'm going to try to get better at that. I'm Sarah Page. I'm the owner of SAP Virtual Resources, offering accounting, bookkeeping, payroll services to small businesses, especially in the construction industry. And I have over 25 years of experience in private corporation. Almost half of that was in mechanical construction. And then I've had my firm for 2 years. So hopefully that helps kind of explain why I am coming on and doing these. So this week I wanted to talk about owner's equity and the ins and outs of it, because I think this is one of the most confusing things for business owners when they get started, is how it's figured out, how owners are paid, and all the fun stuff. So the first thing, owner's equity is the value of your business. So be it an LLC, partnership, even the corporations, uh, those are called, for the corporations, those are called retained earnings. But for the smaller companies, it's an owner's equity or partner's equity. And that is what the value of the business is. When you have your profit and loss, you start with your income, you subtract your expenses, you have your net income. At the end of the year, that net income rolls up into your equity amount. So if it's a positive net income, your company is valued higher. If it's a negative net income, your company is valued lower. There's other parts to the equity, which is your investments and your draws. So when you are putting money in, let's say you are moving a personal vehicle into your business because you've decided that that second vehicle, you're just using it for the business and it's going to become a business asset. So that business asset is entered as an asset to the business and as an investment from the owner, because you are giving it, bequeathing it to the business. So your investment into the business has gone up by the value of that vehicle. Whenever you take draws, your paycheck basically, it comes out of business. So, but it doesn't come out the same way as your advertising does. When you pay for your advertising, when you pay an employee wages or employee payroll taxes, that is expensed out of your business. Owners' draws are not expensed out of the business. They come off of the balance sheet. So if you have net income, let's say for 2023 of 40,000, and you took 30,000 of that as a draw to pay yourself, your profit and loss is still going to show 40,000 as your net income. It's on the balance sheet that it's going to show that you took $30,000 out as your draw, because it's going to come off of the equity accounts that are located on the balance sheet. And the reason it does not come off the expense is your business, an owner themselves cannot take payroll. It cannot run through payroll. You cannot pay payroll taxes, because it is just considered your, it's part of your net worth. It's when you're a single owner LLC, that equity, along with your net income, rolls up into your personal taxes. Now, if you get large enough that you can file as an S corp on your LLC, then you can actually pay yourself through payroll. But when you're just smaller, and when you don't have a lot of assets, when you don't have a large amount of income, then the draws that you're taking to pay yourself, all it is a transfer from your business account to your personal bank account, and it just comes off of that balance sheet there. It can't expense out of the business. So one of the things that I have seen is when someone starts a business and they get QuickBooks. And QuickBooks offers them payroll as part of the package. Hey, do you want to pay payroll? And you go, yeah, I want to pay myself. So you sign up for payroll and you're paying yourself through payroll. And then it gets hard to clean up because then you have to, at the end of the year, amend those W-2s, the W-3 to the IRS. You've got to amend the 940 annual report for federal unemployment. You have to amend the 941 quarterly reports, which are your Social Security and Medicare self-employment taxes, and it's the federal withholding tax. So if you're a single person solopreneur, you can't be doing payroll. And unfortunately, you would be wasting quite a lot of time and money. Money paying for the software and then time getting it corrected. So owner's draws are just a transfer between bank accounts. You can write it by a check, you can do an electronic transfer, but all you're doing is moving that money from your business account to your personal account. And when you're paying yourself, you want to do that first before you pay any personal bills out of your personal account with the money that you just transferred. Easier and cleaner. But that equity does end up causing problems because another thing is when people are looking at their profit and loss and they're assuming that that net income already accounts for those owner draws, and it doesn't. It's before owner draws. So hopefully that will make some sense, help kind of clean up a little of the muddiness of it. If you have questions, click on the link. Let's set up a time to chat. Let's just go over your questions. Make sure that what you've got set up is the right way to do it because it takes a lot more time and effort on the back end to fix something than it does to set it up right. And and like I said, it's very complicated for a lot of people because there isn't an easy guide to explain what to do in those situations. So let's set up a time, let's talk, and make sure you're on the right path. Have a great week, and I will see you next week.